Welcome back. To conclude this topic on the relation between economics and investment markets, we study the equity risk premium as well as liquidity premium in the context of commercial real estate. Let's jump right in. In the last lesson, we learned the components of the discount rate applicable for corporate bonds, which carry some form of credit risk. Stocks differ significantly from corporate bonds in that there is much more uncertainty in its future cash flows. Besides, in the event of company liquidation, equity holders have a lower priority in claims than debt holders. As such, equity investors typically demand an additional premium over the yield on a company's bonds. This is known as the equity premium, which we denote as kappa. Do note that the equity premium we define here is the risk premium over the bond yield. We may also want to define the equity risk premium, denoted by lambda, which is the risk premium over the nominal risk-free rate. The equity risk premium is therefore the sum of the credit premium and equity premium. It is the additional return required by investors over and above the compensation for risk that they require for holding a long-dated default-free government bond of the same currency. Unlike bond yields, which are easy to determine, the equity risk premium is much harder to estimate. Investors tend to prefer assets that provide a higher payoff during economic downturns. This is known as the consumption hedging property of the asset. This property reduces the risk premium on an asset. However, equity prices are generally cyclical, with lower values during an economic recession, so equities are not an effective hedge against bad consumption outcomes. Because of this poor consumption hedging ability, equity risk premium is positive. Given the scale of stock price declines in past recessions, we might expect it to be quite large. US equities have outperformed US Treasuries by 4.5% per year on average, giving us an estimate of the equity risk premium of the US market. As with corporate bonds, the equity risk premium should have an inverse relation to the business cycle. Likewise, sensitivity of the equity risk premium to the business cycle can differ across industries or sectors. Some active managers may attempt to capture returns through sector rotation strategies. Consider two sectors, cyclical and non-cyclical industries. There are periods during which one sector outperforms the other. One sector generates a higher risk premium relative to the other. If investors could rotate out of the underperforming sector and into the better performing sector right before the change in performance, they would generate superior returns. However, getting the timing right is of course very difficult. The point, however, is that understanding and forecasting the relationship between the equity market performance of different sectors and the business cycle may help managers enhance their sector rotation strategies. As we've learned in the equity course, price multiples such as PE and PB are often used in determining the relative values between companies or between industries or sectors. Some analysts also use price multiples to assess the valuation of the overall market from a historical perspective. However, it is inappropriate to judge the multiple in a historical context only. If the PE ratio for S&P 500 is above historical average, it could be that the index is overvalued, but it could also be that the index level is justified by current conditions. Price multiples are positively correlated with expected earnings growth rates and negatively correlated to required returns. A high PE could be the result of an increase in expectation of future real earnings growth, falling real interest rates, a decrease in inflation expectations, a decline in uncertainty about future inflation, or a decrease in the equity risk premium. Other things being equal, any one of these changes, or all of them combined, could justify higher equity prices relative to current earnings, and thus higher equilibrium PEs. One shortcoming of using unadjusted PE ratios is that both the numerator and denominator can be volatile, making investment decisions difficult. The Shiller's Cape measures real cyclically adjusted PE ratio. This reduces the volatility of unadjusted PE by using real inflation-adjusted prices in the numerator and a 10-year moving average of real earnings in the denominator. And to conclude this topic, let's study liquidity premium in the context of commercial real estate investments. For commercial properties, the rental income from tenants gets passed on to investors, so it can be viewed as being analogous to the coupon income derived from a bond. Because a well-diversified portfolio of commercial property could be expected to generate a stable stream of rental income for investors, they might view such a portfolio as being similar to a well-diversified portfolio of bonds. The credit quality of a commercial property portfolio will be determined by the credit quality of the underlying tenants. However, unlike bond investments, real estate investors do not get back a fixed face value of the bond at the end of a lease. Rather, the value of the commercial real estate is influenced by many economic factors, including the state of the economy, the demand for rental properties, and property location. Uncertainty about the value of the property at the end of the lease term gives commercial properties an equity-like character. There is a third aspect to investing in commercial real estate that's also crucial. It's illiquidity. It can take months and sometimes years to exit from a commercial property investment, and the high transactions costs often discourage investors further from liquidating holdings. Based on these arguments, a commercial real estate can be valued based on its expected cash flows, discounted by the sum of the real risk-free rate, expected inflation, inflation uncertainty premium, credit risk premium based on the credit quality of the tenant, a risk premium for the uncertainty about the terminal value of the property, somewhat like equity premium, and a risk premium for illiquidity, denoted as phi. The business cycle usually has lesser influence on rental income, while historically have been more or less steady across business cycles. However, commercial property values tend to be heavily influenced by the business cycle. Because of this, the correlation of commercial property values with the stock market tends to be positive. Similar to equities, real estate provides a poor hedge against bad consumption outcomes. Therefore, the risk premium required by investors for investment in commercial properties will be relatively high and often close to the risk premium required for equity investments. And that concludes this topic on economics and investment markets. Take a break, and we'll see you at the next topic.